All right, so chapter 20 we're going to look at here. It's a fairly short chapter, so this should go pretty quick. Accounting changes and error corrections. And I believe at some point we've talked about this before, so hopefully this is just a rehash and you should catch on pretty quick. All right, so you have different types of accounting changes that you could have, and based upon the type of accounting change, FASB allows you to treat certain accounting changes certain ways. One of the ways they do is one of the types of changes you have is a change in accounting principle. That's when you're moving from one generally accepted accounting principle to another. This could happen for several reasons. It may be the choice of the company. It could be the choice of, well, it could be not their choice. It could be because FASB has directed certain companies or certain industries or the whole accounting world to change to a new accounting standard. But it could be the company's choice, such as changing methods of inventory costing, and as you've seen, changing from cost method to equity method or vice versa. In that case, what you do is you're going to, as we see, change usually retrospectively, but there are some exceptions. The second type of change is a change in accounting estimate. Here, you're seeing a revision because the facts have changed. New information has been received. And so an example of that would be changing depreciation methods, changing the estimated useful life of a depreciable asset, changing the residual value of a depreciable asset, changing the estimate of periods benefited by intangible assets. Something we didn't talk about, changing actuarial estimates. Well, we did talk about that, pertaining to a pension plan. And then last but not least, you could have a situation where you could have a change in reporting entity. That's when you're moving from, let's say, consolidating a subsidiary not previously included, or you could have situation where I'm not sure what that second one says. Report consolidated financial statements in place of individual statements. Oh, okay. So yeah, you've got a company that was already doing consolidated financial statements, and they just happen to include another subsidiary. They gobble up another subsidiary in their conglomeration is the first example there. Second example, you've got two companies that were separate companies. One acquires a majority stake in the other. In that second example, thus they're required to report consolidated financial statements. The second thing we're going to talk about is correcting errors. Errors could be because of mathematical mistakes, could be an inaccurate physical count of inventory. You could change from a cash basis to accrual basis of accounting. You could fail to record an adjusting entry. Recording an asset as an expense or vice versa. Could be because of fraud or gross negligence. And so there's three approaches. First is the retrospective approach, which is all financial statements issued in previous years are revised. And so what you're doing is you're changing the prior statements so that it looks like whatever principal change was made was used all along. Also, in cases of some errors, you have to report retrospectively as well, and so you have to do the same thing for those types of errors. And then on top of that, you have to create a journal entry for any accounts that are affected by the newly adopted method or error. The second approach is to modify or have a modified retrospective method, not go back and change prior years. You change the current period and then all future periods. And as far as the current period, you change the retained earnings to what it would be under the new method. The last approach is called the prospective approach. Here you simply make the change in current and future years. All right, so let's talk about in more depth change in accounting principle. Again, you're changing from one GAAP to another GAAP. Remember that we're trying to be consistent here. The goal is to have consistency between years. By having consistency, you are able to compare one year to the next year. You're looking at apples versus apples rather than apples versus oranges. However, having said that, sometimes circumstances might call for a change, making the new method more appropriate. So, for instance, back in the mid-70s when prices were rising quite a bit, several companies switched from FIFO to LIFO. That was because, if you recall, under LIFO, you take as your cost of goods sold the last items brought into the inventory. When prices are rising quickly, that's going to make your cost of goods sold higher. And so that's what they did. They just changed from FIFO to LIFO. Sometimes FASB makes changes in principles for specific industries. And then, of course, like I said, sometimes FASB codifies a new accounting standard for all the accounting world. Understand that there might be certain motivations by management to change accounting methods, and sometimes those motivations might be well, related to their compensation or something like that. So they might always not have good intentions. It might be used to manipulate the numbers. All right, so most changes in accounting principle require using the retrospective approach. Certainly, most voluntary changes in accounting principles are reported retrospectively, such as when you change from LIFO to FIFO, as this company is here. And so when you have that situation, what you're going to do is you're going to, again, make the statements appear as if the newly adopted accounting method has been applied all along. And so as far as the income statements are concerned, that's what you're doing. You're changing over, in this case, from LIFO to FIFO. That's going to cause the cost of goods sold to be lower under the FIFO method, which means that your revenues are going to be, or your, not revenues, but your income is going to be higher under FIFO than LIFO. When you restate it, it requires a restatement of the net income, and because the IRS requires that when you, well, this is kind of technical and a tax subject more than anything else, but when you move from LIFO to FIFO, you're required to not only restate your income statement, but you have to record the difference well, the tax is going to be owed since income's going to be higher, and you've got to record that tax as a tax liability, and it's got to be paid fairly quickly. And so note here, you've got income that's higher. They've got FIFO listed in here as if it was adopted from the beginning. Now note, they're only doing this for years that are in the financial statements that are current year and prior years. And so you have to list for any prior year that you list in your current financial statement at the time the change is made. You have to go back and make those changes. On top of that, you're going to have changes in, and I'm not sure what they're showing here. Oh, okay. They're showing they're showing balance sheets, but they're saying cost of goods sold. But the bottom line is that they're going to have to show inventory at the appropriate amount under FIFO. This says balance sheets, and I'm not sure why. All right, so if you look at 1165, what you see there is they're trying to figure out the cumulative difference in inventory account. And so what they indicate is that the cost of goods sold would have been 400 million less in FIFO rather than LIFO had FIFO been used in the years before the change. The change being in 2018 in this case. So essentially what they're saying here is that inventory as of January 1, 2018 would be $400 million more. And so that $400 million has got to be dealt with. Now going back here, you see that says comparative balance sheets will report 2016 inventory 345 million higher than it was reported in last year's statements. Likewise, 2017 inventory will be increased by 400 million, and inventory for 2018 being reported for the first time is 460 million higher than it would have been if the switch from LIFO had not occurred. So you just kind of have to take these numbers as they are. So apparently, oh, okay, previous years, I get the point. Previous years, what they're indicating is that inventory would have been 300 million more in previous years, and in 2016 you have an increase in inventory of 45, so now you got it at 345. You go to the next year, 2017, it increases by 55, so that increases to 400. And then the current year, it increases 60, so inventory is now 460. So at the beginning of 2017, I see what's happening. There's an increase in inventory of 400 million moving from LIFO to FIFO. Kind of hard to follow there. The comparative statements of shareholders' equity are also going to have to change because net income increases in this case when you move from LIFO to FIFO. So because retained earnings, net income affects retained earnings, thus a change in retained earnings affects the statement of shareholders' equity. That has to be revised as well. All right, back to this. You've got to make any adjustments for any accounts that are affected by the change. And so as we saw, you've got a change in pre-2018 Uh, in the inventory account, it is 400 million more than what was reported. And so you've got to adjust your January 1, 2018, which is the same as December 31, 2017 inventory balance to increase it by $400 million. And so you're going to make the following entry based upon everything that you've determined. You've determined that inventory has to increase by 400 million. Retained earnings, going back to that, increases by 240 million. Let's see where we found that number. Not sure if we can figure that out. Well, net income is going to increase, which is going to increase retained earnings. So it makes sense that you're going to have to adjust your retained earnings account, in this case, by 240 million. And let's see where we got the income tax number from. So that's 160. Oh, well, there it is. Well, there's both numbers. At the beginning of 2007 or 18, which is the same as the end of 2017, you've got income taxes there of 160 and the net income and retained earnings increasing by 240. So that's what they're doing. They're making the adjustment as of the beginning of 2018, because that's the numbers that have to be adjusted at beginning year end. On top of everything else, so you have to change basically everything when you do the retrospective method. Certainly any comparative financial statements have to be revised. Both the income statements that are comparative, any balance sheet accounts that are comparative have to be changed. On top of that, you have to change any balances that have changed as a result of the change in accounting principle. Retained earnings has to be changed. Statement of shareholders' equity has to be changed. And again, you have to adjust the accounts that are affected by the change by making a journal entry, as we just saw. On top of that, you have to disclose, and in the first financial statements following the change, you have to justify the reasons for application of the new method. Now, you don't have to continue beyond that period, but the first financial statement after the change, you have to list your justification for the change. You have to explain why the change was needed, its effects on items not reported on the face of the primary statements, point out that the comparative information's been revised, and report any per share amounts affected for the current period and all prior periods that are presented. And so you have an example here, Abercrombie and Fitch. So somewhere in there it says the company believes the accounting under the weighted average method, they went from lower of cost or market to the weighted average cost method. And so they believe that the weighted average cost method is preferable as it better aligns with the company's focus on realized selling margin and improves the comparability of the company's financial results with those of its competitors. So that's the justification part. All right, the modified perspective approach. Sometimes you can't retrospectively do things because you just don't have enough information to do it usually. And so here, if that's the case, you're going to apply the new standard only to the adoption period, which is the current period, and you're going to adjust the balance of retained earnings at the beginning of the adoption period to capture the cumulative effects of prior periods without actually adjusting the numbers in the prior periods reported. Now, sometimes it's because retrospective application would be impracticable. Sometimes you lack the information that makes it practical to report a change retrospectively. And so you just make the change. Essentially what you do is you at the beginning of the current year, you make a prior period adjustment to shareholders' equity, and going forward you use the new method. And so here you have a situation where the company's moving from FIFO to LIFO. Of course, they have to justify the change. And if you recall, or maybe we didn't really talk about this too much, but when you use LIFO, you have all these LIFO layers, and sometimes they don't have enough information if they've been using FIFO to about past inventory to figure out the value of those layers. And so here that's the case. And they say that the cumulative effect of a change in accounting principle from FIFO to LIFO is not determinable. Accordingly, such change has been accounted for prospectively. And so you just go for whatever the inventory number is at the current period, that's the number you use, and you just go forward using LIFO method. And so whether it's impracticable to determine the cumulative effect of prior years, or impracticable to determine some period-specific effects, I mean, if it's and one's a little more encompassing than the other. If it's impracticable to determine the cumulative effect of prior years, you simply can't figure out the cumulative effect. you're going to make the change prospectively. Now, if some years you can't determine the effect, you're simply going to change retrospectively beginning in the earliest year possible. Maybe last year, maybe 5 years ago. You could, and going forward, you could figure it out. But whatever that period is, that's where you have to make the change. Now, usually when there's a new accounting standards update, FASB only requires that you use the prospective approach. I mean, and it makes sense that they would do that because they're the ones requiring the change. It's not voluntary, it's involuntary. So an example here would be a change from the equity method to another method of accounting for long-term investments. GAAP requires the prospective application of the new method. Now there are other areas where we use the prospective approach, even though in actuality FASB considers what you're doing a change in accounting principle. If you recall, when we make a change in accounting estimate, those changes in accounting estimates are a change in accounting estimate achieved by a change in accounting principle. And that change in accounting principle simply means that you have to justify your reason for making the change in accounting estimate. And so in that case, since it's a change in accounting estimate, even though it's achieved by a change in accounting principle, you're going to account for it prospectively going forward. So again, it's an accounting estimate, and because of new information or new experience, you're having to change something, and so the change is done prospectively. You simply go forward and make the change. Now, the disclosure note should describe the effect of the change in estimate to income from operations, as well as net income and per share amounts for the current period. So, for instance, one of those accounting estimates that could change is warranty expense. Here you have a company that estimates warranty expense to be 2% of sales. After reviewing 2018 numbers, this company determined that 3% of sales is a more realistic estimate of its payment experience. And so if sales are 300 million in 2018, they're going to make the change accordingly going forward. No account balances are just adjusted. The cumulative effect of the estimated change is not reported in current income. Rather, in 2018 and later years, the adjusting entry to record warranty expense simply will reflect the new percentage. So in 2018, they'd simply record an entry for warranty expense of $9 million. And of course, your corresponding credit would be to warranty liability. And of course, here we have to show the after-tax effect of the change. So that's why they're calculating the 1.8 million there. Here's another change in estimate, moving from different one depreciation method to another. That's a change in estimate if as a result of a change in accounting method. And so again, we go forward and we make the change. So here we move from sum of the years digit method to straight line. Change affects its equipment purchased at the beginning of the year at a cost of $63 million. Machinery has an expected useful life of 5 years, an estimated residual value of $3 million. And so they've already depreciated 36 million of the 63 million. And so they're going to take the 27 million, take out the estimated residual value, meaning they've got 24 million to depreciate over the next 3 years. So 8 million going forward in depreciation expense and accumulated depreciation. And of course, you have to justify the change in estimate since it's a change, it's done by a change in accounting principle. And you have to show the cumulative effect on earnings as well as earnings per share. Again, sometimes you can have a change in reporting entity moving from one type of entity to another. Usually it's dealing with consolidated financial statements. So consolidation in place of individual statements, changing specific companies that constitutes the group, changes in accounting rules, or one company acquiring another. You report by recasting all previous financial statements as if the new reporting entity existed in those periods. And on top of that, a disclosure note should describe the nature of the change and the reason it occurred. Let's talk about errors. Again, there might be different reasons why the error occurred. But, you know, something occurred that either a transaction was recorded incorrectly or not at all. And so if you have that case, normally the general rule is you're going to retrospectively restate the financials and certainly any accounts affected. And so this kind of gives you a summary of everything that we've talked about up till now, plus errors. All right, so as far as errors are concerned, since the general rule is that you retrospectively restate financials, we're going to take this in a step approach. So an addition or reduction in beginning retained earnings balance in a statement of shareholders' equity is the situation here. So step one would be to make a journal entry to correct any account balances that are incorrect as a result of the error. Step two, previous year's financial statements that were incorrect as a result of the error are retrospectively restated to reflect the correction. And that's for all years used for comparative purposes. Step three, if retained earnings is one of the accounts incorrect as a result of the error, which it often is, the correction is reported as a prior period adjustment to the beginning balance in a statement of shareholders' equity. And step four, a disclosure note should describe the nature of the error and the impact of its correction on net income. And probably you should do earnings per share as well. All right, so we got this company here. Let's see where we are, see what they're trying to tell us here. Okay, so here we have this company, and let's say in 2016, income was overstated by $20,000. In that case, what you would do in 2017 is if that, and what you have to understand is the current year is 2018, 12/31/18. So you've got comparative numbers here, statement of retained earnings, with 2017 being the comparative. And so since the error occurred in 2016, in 2017 you would show a prior period adjustment to reflect the change that needs to be made as a result of the error in 2016. So that's pretty easy. And what you have to understand is there's any number of ways errors, any number of errors that could happen. So as long as you understand the general steps, you can figure out how to correct any error. As they indicate here, it's more complicated to deal with an error if it affected net income in the reporting period in which it occurred, because you've got to go back and make a change to this statement of shareholders' equity, certainly if it's not discovered until a later period, in most cases, it's going to make things more complicated as well. If you find the error in the period that it occurs, you simply reverse the entry. If you made an entry, an incorrect entry, you simply reverse that entry and make the correct entry if you discover the error in the correct period in the same period. You know, if no entry was made but should have been made, and you discover that in the same period, you simply make the entry. But if it's any of those done in a later period, that certainly complicates matters. All right, so here you have a situation where the error discovered the error is discovered in the same reporting period that it occurred. Okay, so this is the easy one. GH Little Inc. paid $3 million for replacement computers and recorded the expenditure as maintenance expense rather than computers. Okay, so they should have capitalized computers, but they expensed it. And so what you're seeing here is the reverse entry. The original entry was debit maintenance expense, credit cash. Well, they simply reverse that entry and record here equipment, debit, credit to cash. When you have an error that affects previous financial statements but not net income, you're going to have a note to the financial statements, first of all. And so if the error did not affect net income in the year it occurred, and examples would be recording salaries payable as accounts payable, recording a loss as an expense, classifying a cash flow as investing activity rather than financing activity. You're simply going to, as they do in illustration 20-16, you're going to make the change. Okay, so they have in that example, they incorrectly recorded a $2 million note receivable as accounts receivable, and the error was discovered a year later. You're simply going to, okay, and again, it was incorrectly recorded as a note receivable. Oh, incorrectly recorded a note receivable as accounts receivable. So you're going to back out the $2 million out of accounts receivable. So you're going to credit AR and you're going to debit note receivable. And of course, this has to be something that's material to disclose it and do it in a if it's a relatively minor error, you're not going to make the change. You're just gonna ignore it. So it's got to be a fairly material amount that the error uh, affects accounts. So here's that example. Now, not only do they have to correct the accounts involved, if last year's annual report, including the balance sheet, was uh, reported for comparative purposes, that last year's balance sheet would be restated to report the note as it should have been reported in that year. Now, since last year's net income was not affected by the error, the balance in retained earnings was not incorrect, so no prior period adjustment to the account is necessary. But you do have to disclose in a note the nature of the error, note that there was no impact on net income or income from operations and earnings per share. But like I said, most errors affect net income. And when they do, they affect the balance sheet as well. And so both statements must be retrospectively restated. So also, the statement of cash flows can be affected as well, and so that will need to be restated as well. Any incorrect account balances must be corrected. Even though we're not going to talk about it, income taxes often are affected. All right, so here, internal auditors in 2018 discovered that this company had debited an expense account for $7 million cost of sorting equipment purchased at the beginning of 2016. The equipment's useful life was expected to be 5 years with no residual value. Straight line depreciation is used, and so they find this 2 years later, right? So there should have been in each year $1.4 million in depreciation expense. Also, equipment should have been recorded instead of an expense account. So compare the incorrect to the correct. So depreciation's accumulated depreciation is understated by 2.8 million. Depreciation expense as well. Net income is overstated by $4.2 million. Now think about that. Total expenses in 2016 were overstated by 4.2 million, the after-tax effect. So net income and retained earnings were overstated by 4.2 million. Actually, they've got that wrong. And I was like, what? Because expenses were overstated by 4.2 million, net income and retained earnings are not overstated, they're understated. And so not only do you add the equipment, you add for $7 million, and you credit accumulated depreciation to catch up the accumulated depreciation for the prior 2 years, 16 and 17, to 2.8 million. So now you're current on your accumulated depreciation. Well, since your expenses were overstated, your retained earnings and net income are understated by 4.2 million. You're going to credit retained earnings for 4.2 million. So anyway, bottom line, if you use, and here we just have comparatives for 2017 and 2018, your prior period adjustment for 2017 is going to be 5.6 million to retained earnings, because that's the difference between 7 million and the 1.4 million in depreciation expense that should have been expensed. And then in 2018, the prior period adjustment is going to be 7 million minus the 2.8 million in accumulated depreciation that should have occurred by the beginning of 2018. And so the prior period adjustment is going to be 4.2 million. And of course, there has to be a disclosure note that describes the nature of the error, the impact of the correction on each year's net income, and the effect on income from operations as well as earnings per share. All right, so here we have an error also that affects net income. This would be where you're recording an asset as an expense. And so what you do here depends on when the error is discovered. For instance, when you record an asset as an expense, a depreciable asset, if you discover the error late enough to where it's in a period where the asset would have been fully depreciated anyway, then uh, there's no correcting entry that's going to be needed. And we'll show you that here in a minute. But most of the time you find the error, and again, these are material errors, within that time. Let's say it's 2 years down the road, like we just saw, uh, on a 5-year asset, then you're going to have uh, to make the changes accordingly. So here what they indicate is that if the error in our illustration is not discovered till 2021 or after, no correcting entry at all would have been needed at that point, because the $7 million asset would have been fully depreciated anyway. Therefore, the full effects of the error have been corrected. And so most errors eventually self-correct. But having said that, even though the errors eventually correct themselves, they cause the financial statements to be misstated in the meantime. So here we have an example where this company in early 2018 discovered a $1 million amount of inventory that had been excluded from its 2016 ending inventory account, thus causing an understatement of ending inventory, which means cost of goods sold was overstated, because cost of goods sold in 2016 was overstated, means that net income, thus retained earnings, were understated. You go to 2017, that next year, because ending inventory in 2016 is the same as beginning inventory in 2017, beginning inventory in 2017 is also understated. Therefore, cost of goods sold is understated in 2017, which means that net income in 2017 is going to be overstated by the same amount that it was understated in 2016. So, bottom line is that while retained earnings in 2016 were net income and retained earnings were understated, because the amount of net income has essentially caught up by being overstated in the following year. The error has corrected itself. So nothing needs to be done if found in 2018. It corrected itself. Now here they change up the situation. In early 2018, Overseas Wholesale discovered a $1 million amount of inventory that had been inadvertently excluded from its 2019, I think that's 2016 ending inventory count. Um, and all they're trying to do is point out here, if the error is discovered in 2017 before closing the 2016 books, they would just simply make the correction. Well, no. I think what they're saying there, if it's found in 2017 before the 2017 books are closed, they would simply add 1 million to inventory, and of course that would have changed or affected retained earnings by that $1 million. So they would make the change in 2017 before closing, and of course, like we saw, no correcting entries needed if discovered in 2018 or later. And of course, if you have 2016 financial statements uh, as comparatives, you have to retrospectively restate those to correct or reflect the correct inventory amounts, cost of goods sold, and retained earnings. If the error is discovered in 2018, 2017 financial statements, again, that was the comparative financial statement that's retrospectively restated to reflect the the correct inventory amounts, cost of goods sold, and retained earnings, but no adjustments needed for 2018. So you would have the 2017 beginning retained earnings balance. After that, there would be a prior period adjustment to reflect the incorrect inventory amount, thus understating net income, thus uh, retained earnings or shareholders' equity. And then you'd have your disclosure note. Now, what happens if you fail to disclose or record sales revenue? Here you have a situation where $3,000 of merchandise were sold in the last week of 2017 and wasn't recorded until the first week of 2018, and thus the merchandise sold was excluded from 2017 ending inventory. And so they should have recorded a $3,000 accounts receivable, and the credit would be to revenue, and there should have been no entry made in 2018. So we correct the incorrect accounts. (2017) financial statements that were incorrect as a result of the error or are retroactively restated to reflect the correct amount of sales revenue. So they'd be lower, well, actually higher by $3,000. And of course, accounts receivable would be higher by $3,000. Got all kinds of errors in this. It says because retained earnings is one of the accounts incorrect as a result of the error, the correction to that account is reported as a prior period adjustment to the 2015 beginning retained earnings balance. Well, if you've got comparatives there, I think it's actually going to be either the 2017, 2017 beginning retained earnings balance. And of course, you have your disclosure note. All right, so that's it for chapter 20.